Hello, my name is Alistair Anderson from Unigestion, and today I'm joined by Florian Ielpo, Head of Macroeconomic Research here at Unigestion. Florian, what's your overview of the macro environment?
Our vision of the macroeconomic environment is based on an assessment of the three key risks that any multi-asset portfolio would be faced with: recession risk, market stress risk, and inflation risk. We've designed a set of indicators to help us track down those risks. We call them the nocasters. They are indicators that do not make forecasts about the risk, but just help us understand where do we stand as of now. So what are these indicators saying? What they are saying is that growth over the first half of the year has been more than decent. It's been widespread, touching emerging countries, developed countries in the meantime, and all of that had two consequences. The first one is that recession risk currently is very low. And the second one is that with this low macro uncertainty, market stress risk is also low, and you can see that through volatilities. Now, we think that for the rest of the year, the key question is the inflation risk. We've had a surge in inflation starting in summer 2016 that then decreased as the Fed started to hike rates. Now we think that this lower inflation as before is only a temporary phenomenon on the road to reflation. We still think that reflation will take place, and especially by the end of this year. And there are three key factors behind that. One is the fact that demand is strong enough to generate inflation. It's especially strong across emerging economies. The second one is that the growth in wages is also strong enough to see a bit higher inflation. And finally, the last element, of course, is commodity prices and oil prices, and we foresee a marginal drop in the production of oil by year-end.
What are your key investment themes?
Consistently with this understanding of the macro environment, we have two key investment themes. The first one, of course, is this growth story. We foresee the continuation of the growth story, and we would like to be invested in the assets that are profiting from it. We think that equity returns should remain solid by year-end. Now, the second direction is the inflation story. And with this inflation story, we think that with this normalization of inflation, we'll see an improvement in inflation expectations progressively. And we see all the more this improvement as we don't think that the Fed will be as aggressive for the rest of the year that it's been for the beginning of the year. So basically, this second theme is an overweight in any asset that would be profiting from a normalization of inflation.
And finally, Florian, how is this reflected in your investment portfolios?
The core of our dynamic asset allocation process is currently overweighting two types of assets. The first one, of course, is related to growth, and we have a preference for developed equities. We think that emerging equities did already a lot, and even by historical standards. Now we think that we are still seeing this continuation of this rally in developed equities. The second overweight that we have is for inflation-related assets, meaning inflation break-evens and commodities. Those are the two key overweight that we have for the inflation story. Also, we are still acknowledging the fact that we've had already an excellent year when it comes to equity returns. And it's probably time to try to crystallize a bit of this performance. With that in mind, we've added to our portfolios hedges in case of a downturn, and different types of hedges, essentially through options on equities and bonds, but also through a short euro-yen position that should prove to be a decent hedge in case of a fall in markets. We think that at this point of the cycle, it's time to make of risk management potentially your third overweight across your portfolios.
Florian, thank you very much.